I don't want to take someone who I know has money and explain to them why they need to invest in multifamily. I want someone who has done the research, they've educated themselves. Maybe they led Rich Dad Poor Dad. They understand the value that we're bringing them, the convenience and the professionalism that we have in our processes, and they want to work with us because of that. Not explaining to someone why we're the best investment product, if you will.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Craig, welcome to the show. How you feeling today?
I'm doing well. How are you?
I'm doing very well, very well. So, I'm a Philly guy. I don't know if you knew that or not. So I'm riding off the high of the Super Bowl yesterday. So, can't complain.
Yeah, well, you know what? There's not a strong accent on your end. Perhaps that's been washed out of you, but you get that kind of Pennsylvania accent. It's quite distinct if if you're from that neck of the woods. Just like a Jersey accent is pretty distinct, or can be.
Yeah.
A Philadelphia, Pennsylvania one can have a certain kind of dialect that is quite unique to the regional vicinity.
Without a doubt, it's funny, and I've often heard people that I maybe don't have the traditional Philly accent, and I don't know. I mean, it's hard for somebody in the thick of it to understand, but yeah, people have told me I don't sound like I'm necessarily from there, so
It's starting to come out a little bit more. I can hear it.
The more I
but
talk,
it's subtle.
do we start saying words like Acme, water? Water's a big one for us. I mean,
Birds.
birds. Go birds. You start spelling eagles wrong, then you might be.
Yeah.
And really. But enough about me. Let's talk about you. So let's start. If you could just introduce yourself. I love to hear people introduce themselves in their own words.
Yeah, certainly. My name is Craig McGrouther. Hello, hi. I'm Director of Business Development at Lone Star Capital. For those of you who don't know who Lone Star Capital is, we are a New York-based, as you can see in my backdrop, for those who are listening, firm, owner, operator. As I mentioned, we've got office space in the One World Trade Center. We do have deals at the moment exclusively in Texas, although we're going to be expanding into Arizona and take advantage of the kind of changing market there. We've got it currently about $700 million of assets under management, and we only buy multifamily housing.
Gotcha. Awesome. So, I always just assumed you guys were in Texas because I know that's where you're mostly by. I did not realize your main office is in New York.
Yeah, so the headquarters are based there, and kind of the reason and the why behind that is Rob, who's the co-founder, as well as Kent. Kent is from Brooklyn, New York. Rob, like myself, is from the Bay Area, the Silicon Valley. So basically between San Jose and San Francisco, two massive MSAs naturally in the Northern California pocket there. He went to community Carnegie Mellon, but he was going there to play football. Ended up not working out playing football there. He just realized, hey, my heart's not in this. I'm not going to go pro. So spent the summer in New York and fell in love with the city. So he always wanted to go there. Following graduation, turns out he never graduated because he's a college dropout, and then moved to the city, and it ended up kind of never looking back in that sense. So that's kind of the genesis as to the why. Kent was already out there. Rob wanted to move out there, and then now we've kind of planted our flag in New York City, and it's made a lot of sense, to start naturally being in that area. You're located to debt and equity, institutional sources on both ends. Not that that's necessarily the route that we capital raise and what our formation is built on or comprised of, but from starting, it was a logical kind of point there. And also, I will say, I mean, this, Peter, the business is very interesting. A lot of people, there's nothing wrong with this, do it remote. Maybe, do it when they're starting working, if they're young and from their parents' place, whatever it may be, right? Totally, no judgment. But having the gravitas of having One World Trade Center office space and in my email signature is, a little bit of vote of confidence that certainly kind of displays a little professionalism and competency. But funny enough, to make this more convoluting and confusing, although our deals are all in Texas, our office is in New York City, of course. I'm the only remote employee, and I live in Phoenix, Arizona.
Wow. Okay. Well, you know what? I was going to ask you, what are some of the benefits of working out of New York City? Because it's such an epicenter for finance. And you kind of answered it, but any others that come to mind or?
Yeah, I think the energy of the city from an employee perspective is one thing. Now, I'm kind of on an island. I kind of fell into this business in a different way. But from a hiring perspective, typically speaking, you've got really good talent that attracts to go to the city. It's not as maybe as cheap, or you could probably get really good talent for a little bit lower of a price in a Texas area. But naturally, or throughout the country, rather, whether it doesn't have to be necessarily just in Texas. But I think from the perspective of human capital, it's pretty solid there, generally speaking. To get the kind of foot going, to legitimize being around, really smart institutional people, and the brain share of the city is one thing. And then also the energy of it. Turns out, incrementally speaking, as I'm sure you know and your audience knows, the ever so slightly more dollars that you make, your life gets a lot better, right? So I think the hustle from an employee perspective, wanting to kind of improve your life, to do well, get promoted, is out there as well. You can live pretty well for not too much. You mean obviously less before in Phoenix, prior. Even to me moving here, and I've been here for 5 years now. It's not cheap here by any means. It's actually the most expensive landlocked state now, believe it or not. But that said, pretty good living. You don't have to make that much to live pretty comfortably. New York City, every $20,000 increment is a big difference in your lifestyle. So that's kind of one of the unseen benefits I think you do get from, of course, being New York based, where people are kind of hustling out there, or you can't have that reputation for doing so.
Yeah, that's a really good point. So talk to me about how you got started with Lone Star, and kind of the evolution of where you started to where you are today.
Yeah, so I had no ambitions of kind of coming into the private equity world or doing multifamily, to be honest. I actually was a realtor. I kind of came out of the womb loving SportsCenter, watching ESPN and HGTV, like flip shows. And I was like, okay, well, this seems like a clear path to make money in the residential space. So got out of college, graduated from the University of Arizona, other known as the Harvard of the Southwest. Went to school there, and then started selling homes, was doing that in the Bay Area. Quickly realized that the Bay Area was not really the place for me. Culturally speaking, price wise, weather, kind of the whole nine, just wasn't really for me. I thought I would be selling houses there forever, but of course, God and such had other plans for me. So then moved to Phoenix, started to sell homes out there. Was doing really well. It was the summer of 2020, but I met Rob Beardsley, and around that time, he was kind of taking Lone Star, maybe had a couple of deals under management, saw what he was kind of doing, and kind of realized that what he had going on was special, and at some point, maybe it makes sense for me to be a part of it. The one thing I will say about selling homes is it's a great living, but it's a little bit daunting. You start from zero every year. Although it's compounding, you ultimately want to get to the point where you're investing. You get to the I side, as Robert Kiyosaki would say. And for me, it's like, hey, if there's an opportunity for me to get to the investor and the principal side as quickly as possible, that's going to give me the lifestyle that I ultimately want, which would be if I was selling homes, to buy a bunch of real estate, buy a bunch of single family properties, get the passive residuals, kind of have your retirement set up from that, basically play in that space. Well, it turned out that an opportunity came up where I could get in a company ground floor, and because at the time I joined, it was maybe $150 to $200 million of assets under management. Now, of course, we're at 700 million. So there's been pretty exponential growth there in, my short tenure. But it just seemed like a very good logical fit. Also, it was a very unique opportunity where didn't really have to interview for the job. He knew what I brought to the table. There wasn't really a formal salesperson or capital raiser in the space there at the company. So I kind of just spoke into existence, like, hey, Rob, at some point it'd be great to work with you. I was in his ear about it for, a couple of years. And then lucky enough, he brought me on, and no looking back since. So hopefully that was a coherent and easy timeline to follow there.
Definitely, we have a lot in common when it comes to just kind of the evolution in the space. I got started raising capital at a young age, and got thrown into the investment side very quickly. Because growing up, my dad worked in property management, so that was really like the side of the business that I saw. And he
You've seen the horrors.
Yeah, oh my God. I mean, I always tell that when I go on podcasts, people ask me, same questions I'm asking you. It's like, that was my introduction to real estate, was 2-3 o'clock in the morning. If it's a snowstorm or something like that, he's up. And even when he was up, high up in his career, and I mean, he was still up and telling guys where to go and putting crews different places and things like that. So I just thought, man, that's not for me. I don't think I really want to do that. And then I was just thrown into the investment side and kind of never looked back. And it sounds like you're in the same boat there. What would you say? What were some of the things that attracted you to the space that, because it sounds like it's kind of partly you were on one side of the thing there, realizing the difficulties of, the realtor life, which I have my license, and I've done that kind of stuff as well. And mostly on the commercial side, where it's like, yeah, it's a grind, that kind of thing. But you're on the business development side. It's similar, right? In some ways. So I'm curious to, like, what were what were some of the things that what were some of the biggest differences, as you evolve from that grind to the business development, raising capital grind, that kind of thing?
Yeah, great questions. Lot to unpack. So I'll say first off, um, realtor compared to what I'm doing now, I'm actually with the team, and it's really fun to actually be working with the team. When you sell homes, when you're in the commercial world, yeah, maybe you've got a couple of confidants, maybe you've got, an office manager or, a senior broker or something of that nature that's kind of, supervising and whatnot. Maybe you go to the team meetings and stuff, depending upon the affiliation and how each office and setup is, there, which is cool, but it's really isolating and it really is just your own business. So being in a space where it's more collaborative is really fun. The other difference is, when I was selling homes, I was making really good money. The market was like white hot in 2021, 2022.
Mm.
It basically stopped really selling homes, really caught it roughly around, I would say, second half of the year in 2022. And at that point, I already sold like 30 or so houses, which was a lot, obviously.
Sure.
So I was making good money. And you could have months where you make 80 grand a month, 60 grand a month, big, big months.
Mhm.
Not really getting pops like that right now, unless there's a bonus, of course, that comes our way. But those will be coming once we go full cycle on deals. So it's just different having, it's no better, no worse. It's just now I'm in a world where I've got a salary, so I got know my money coming in,
Yeah.
coming out, so to speak, and can invest accordingly. But there's not going to be those crazy, crazy months as of right now, at least. It'll be delayed gratification where you do get those once we go full cycle and when things come back. But I'd say the biggest thing, finances aside, is certainly I would actually say is the team aspect, collaborating and working with other people and whatnot. So that's super cool. And, fortunately, my team's super high level, buttoned up. Everyone I work with on my side of things is really awesome. I can only speak to those experiences there. And, we have an idea, we move quickly, we execute, and that's super cool. And we also have the resources, the company. If one of us has a good idea, next thing you know, it'll be executed, implemented, and put in place. And we'll reap the benefit pretty quickly from that, which is really unique. And I think, all that said, if it wasn't this company that I worked with, I wouldn't be in this business. I wouldn't care to. I would be selling houses still. Maybe not as happy as I am right now. But it would have to be a really, really organic, unique setup. And it actually worked out that way exactly.
Yeah. Wow. That's awesome. That certainly gave me some questions there because I came from the world of raising capital for a company, and it wasn't really on a team per se. It was just me and the CEO of the company, and he was doing a lot of the marketing. When I look back now at my own company, and I'm kind of doing both sides of the marketing, getting the phone to ring, and then doing the sales side of getting those phone rings to actual dollars in, so in the fund and that kind of thing, and then everything that goes on from there. But it was one of those things that, like, wow, it was such a learning experience, like how much goes into actually making the phone ring and all the marketing. And I see you, dominating on LinkedIn, every time I'm on there, you're doing stuff. I mean, so I'm curious to explain to us what the team is. I mean, what does it look like? What are the dynamics of the team? Who's on it? And what are the roles? And then, how is it just working with the company? What kind of resources are they giving you? And then so the listener understands as well, what's the goal at the end of the day? You're raising capital, right? I mean, so you got to fund deals. Is it through a fund? Is it individual syndications? So let's just dive a little deeper into, what the process looks like, the players, all that kind of stuff.
Yeah, well, I guess on my team ends, from a content perspective, it's funny. My team just posts stuff all day long. I do recordings like this. I do 2 podcasts a week, one with Rob, the co-founder of the company, and then one typically with a guest, or I'll do a solo podcast there. And next thing you know, it's clipped up, put online. So the team really streamlines that. I'm not even familiar with it. That's how great it is. It's like little elves and fairies come out in the middle of the night. They edit everything.
Yeah, that's awesome.
Yeah, they literally edit it up, posted it in there, and it's great. So it's pretty hands off there. With regard to the team and how it works out, we're all working for the common goal, which is to make sure that our deals are funded, that we're buying our deals, and everything is good there. So we've got Dasha, who's our director of investor relations. You've got myself, who's the director of business development. So she kind of handles, some ongoing questions, some partnership stuff, onboards our partners, our capital raising partners, who we third party out some of the capital stack to. You've got Brad Oliver, who does our director of acquisitions. He basically does all the underwriting now. Basically, that's all on the kind of, capital market side of things, the build up there, if you will. So that side of the team is all kind of dialed in that sense where we are ultimately working together for a common goal to basically raise the capital there, put the systems in place, and then Brad does, acquisition. So similar but different. And then you got the asset management and property management side of things, which is a different side. But the ultimate goal is to basically syndicate deals, not to do a big fund structure. We're raising, call it, $150 million, and we discretionarily buy deals and all the money is funded there. What we do is we syndicate individually. For those who don't know what that means, we'll basically take a property that's in that middle market size, which is somewhere between a 30 to a $60 million deal, or maybe even 70 million now, technically, with numbers changing. Now, we typically want a minimum of about 40 million. So we're typically speaking, just from a size perspective, looking for a deal 40 million to $60 million in size. That will be somewhere between a 12 to a $20 million capital raise on an individual deal. And we'll basically, I have the pleasure of trying to find, that capital size in about a 65 to 90-day window, typically speaking, to find investors and capital raising partners like yourself who'd want to come in and take a sliver and a tranche of that capital stack. So typically speaking, we internally raise about $4 to $5 million per the deals from our systems, from marketing, from conversations like this that get posted out, from people coming into our systems, and then we will third party the latter amount of the equity via fund to fund, typically structured opportunities where someone might raise 500K to 5 million per deal.
Wow, gotcha. Okay, so what would you say? Is there a difference in your marketing, like at times when you're in between deals versus, like you said, deals under contract, you have 60, 90 days, whatever it is. Is there a difference in how you approach that in the marketing and that kind of thing?
Marketing stays the same. It's really just email work, outbound, and kind of funneling, when we do get leads coming into our systems and whatnot, how we kind of address those conversations. I would say we've been very fortunate and one of the more active buyers in the last couple of years, in the sense that we've been able to acquire in 2023, which when the market was really slow, we still did about 150 million of acquisitions. And then in 2024, we did about $190 million of acquisitions. So we've been fortunate, typically speaking, be able to have a deal going on. And it's kind of hard to build relationships and have partners if you don't stuff them with deal flow, because one way or another, people get excited to be in the space and they will find a place to make money because they get, excited maybe from going to some sort of conference, some of this, some that. There's deal flow being had. So, people, usually get fed with opportunities, if you will. So it's nice to be able to make sure that they are accommodated in that sense. And, we're typically speaking in a perfect world, although the world's not perfect right now with treasury rates right now and the election in Q4 kind of, really killing deal flow at no fault. That's an apolitical comment. It's just, with the treasury run up, with everything going on there, deals are kind of non-existent, but it's coming back. So we're a little bit slow right now, but typically speaking, we're always raising for something, or there's space there, which is great because then you can bundle people accordingly to the opportunity.
Awesome. Well, just so the listeners know too, I'm going to ask about, what you guys buy, what you like, what you were doing in 2024 versus what the plans are moving forward. But anybody that knows me knows I love capital raising, investor relations. So, and had to be able to talk to somebody like yourself about it is awesome. So I'm going to continue on that path for a little bit, and then we'll get into what you buy, where, all that kind of stuff. But curious, what are the what channels would you say are working the best, for meeting accredited investors, that kind of thing. And then I'm just curious, to what the conversations look like. How you get somebody from a phone call or an email to them putting up, writing a check for you guys.
Yeah, so good question. So I would say the systems now we're getting people into it is really LinkedIn. And then outside of that, fortunately now that we're about 700 million AUM, Google will come up and help us out, and also referrals. We're big on referrals. I mean, if you don't have referrals, you don't have a business. You need kind of couple systems. You need new partners, new investors, new capital raising partners, or sorry, new partners, new capital raise investors, repeat partners, repeat capital, people, right? And referrals on both sides. So if you have all of those three things together, you're gonna have a really good business. So fortunately, we've had all those kind of systems come to place. LinkedIn's been a very good channel. I even heard as much as to say ChatGPT. They looked in how, they want to 1031 exchange some dollars because we're big fans of the 1031 exchange tick process. And fortunately enough, we came up from a ChatGPT search. Go figure. So we're kind of all over. We're everywhere, I think there is. And if you're niche down and know what you're looking for, we're there. We're really not the type of people that, or at least my perspective is, I don't want to take someone who I know has money and explain to them why they need to invest in multifamily. I want someone who has done the research, they've educated themselves. Maybe they led Rich Dad Poor Dad. They understand the value that we're bringing them, the convenience and the professionalism that we have in our processes, and they want to work with us because of that. Not explaining to someone why we're the best investment product, if you will. So I think that answers the first part. And if you wouldn't mind re-asking the second.
Yeah, no, that definitely, it kind of answers, the blend of questions that I had. And it's funny you mentioned the chat GTP. I've had two people call me in the last like 6 months, and they did something with chat GTP. They couldn't give me the exact, what they typed in at the time. And we somehow came up in whatever they were looking at, and it led to a conversation. And also it's funny how I get it's picking up things you put out there, right? You know what I mean? So it's just another kind of channel. If somebody searches the right thing or types the right thing on there, it's a possibility of coming up. So no, I think you answered the questions that I had around channels, because I think that's important for accredited investors. It's like, where do you find new deals? You know what I mean? And two, like, is it normal? You know what I mean? Because I think Facebook's one of those things where, people tell me all the time they talk to people on there, and LinkedIn. So it's like, I think a lot of investors are still maybe afraid of approaching people they find on some of those platforms, but there's plenty out there that are calling, they're making deals happen, all that kind of stuff. So if you're stuck, you're kind of stuck in the Stone Age. If you're an accredited investor who hasn't, done some research and found some, syndicators and fund managers and, just passive deals on, LinkedIn and Facebook and other social media and that kind of thing. So.
Yeah, I mean, we'll be, we're everywhere you can be. We're on YouTube. We have so much YouTube content. So, we make ourselves very available. It's kind of funny. We're trying to stay away from Facebook ads and kind of ads of that nature. The reason why is we kind of become a commodity. People are looking for the highest rate of return, which usually means you're going to get 100% of nothing, potentially. They don't realize the risk adjusted nature to these things. So, we've kind of found that, hey, unless you're going to present them absurd IRR, that's not really realistic. We're just not interested in investors. So that's why we like the organic solution, which is people maybe have seen our podcasts who understand how Rob and I kind of go about things. They've seen some of our deals. Maybe, their friends have worked with us before. That's the investor we're typically speaking looking for, not the individuals looking for the highest return, because that's just not something we're comfortable doing. And, obviously those who got or look for the highest returns and the craziest business plan, the most levered, are the ones that might be struggling the most right now. So
Sure.
those are just not really the people or the deals we're trying to cater for.
It's a very short-term approach too. You know what I mean? A lot of the investors that I know have been doing it for a long time will tell you, you got to look at things over the course of a period of time, because you can have deals like that, where you're chasing yield and maybe some of them work out for you, but then there's others that don't, so it's like, really, what is your IRR, what's your rate of return over a period of time, 10 years versus, 2 years or something like that. So you got to put things into perspective, because at that point you're really playing the game of, you're not going to hit grand slams every time, and you really, I completely agree with you. I think this is such a relationship-based business that, sometimes you want to start small and get to know somebody and understand how they work and that kind of thing, which kind of leads to my next question. I'm curious, on the fundraising side, I always feel like it's extremely important, if you're raising capital, that you got to have a really good understanding of everything that's happening in the business. Because when you talk to, and you don't have to, I mean, there's definitely, I've talked to people, who are on the investor relations side who, it's not the way they do it or whatever, they're at different levels of the business. But I've always found that it's extremely important to be able to understand how the deals are being found, how they're capitalized, how they're underwritten, analyzed, what's going on in the market,
Yeah, super
execution.
essential.
Yeah, so I'm curious to hear your thoughts on that, and then how, coming from, agent world, how you came into this space and what you've done, to kind of educate yourself on multifamily syndication, because I think that'll be very helpful for accredited investors too, who maybe are coming at it with no experience and no background in the investing side of the business. Yeah, maybe they're not even, they know houses from, living in one, that kind of thing, So I'm curious how you've educated yourself over time and how you've gotten comfortable and confident with all the different facets. Because in your role, I'm sure people are asking you a little bit of everything, right?
Yeah, I mean, they will ask you just very direct questions pertaining to the underwriting, like, hey, how do you use the model? How do I edit it? What are your assumptions here? What are your assumptions there? And obviously, if you give 10 different operators the same deal, you're gonna get 10 different answers, right? Or turn structures, which is the crazy and also the kind of artistry, if you will. It's art and science when you come to the world. So, with an educational perspective, fortunately, Rob was patient and taught me. He knew that I would figure it out at some point, and I did. It took some time, and it's funny, even now to this day, I'm still learning more and more about the models and systems and stuff. So, I look at real estate as a Latin-based language, and residential, let's call it Spanish, and multifamily is Italian, right? There's some similarities, but there's
Yeah, I
some
was gonna say, yeah.
obviously there. So, but that said, I mean, it just kind of took some time. I was kind of Rob's shadow for a couple of years, maybe a year and a half or so, and then I would say really about May of last year, the training wheels fully were off, which is awesome. Where, I'm kind of spearheading the entire equity initiative there. And, you just learn the language over time and, you make yourself available and educate yourself with podcasts and, really just sit down and listen to it. And then also, fail, if questions come in, I would try to answer them and send them to Rob. And then Rob would say, no, that's wrong for XYZ reason. And he'd basically just school me up that way. So it was pretty organic in that sense.
Yeah, that was the same for me as well. Being able to have somebody there that you can lean on and kind of shadow and teach you the ropes and that kind of thing, I think is extremely important. It's if for somebody who's getting into the space and wants to invest passively or actively, without having that mentor, somebody to lean on, to ask questions to, and somebody to kind of guide you. It's a challenge, and I mean, if you don't have that, I don't. God bless you. I don't know what you do. But there's a lot of resources out there and things like that. What would you say are some of the most kind of common questions you get, and then do you feel like a lot of people are coming to you because you guys create so much content, coming to you pretty well educated about what you do, or what's that look like?
Yeah, so common questions varies. It depends on the deal. If it's an affordable deal, which we do a substantial amount of those, it's, hey, how does affordable restrictions work? Is it transferable? Things of that nature. Why are you doing this? Why are you making, deals rent controlled, if you will, there, juxtaposed to, people usually invest in Texas for the opposite of that, which is
Yep.
counterintuitive to a certain extent. So that's kind of one angle on that there. And then what was the other part of the question? Sorry.
Just how are they coming to you pretty well educated
Yeah,
on the content?
yeah. I would say honestly, I'm really shocked sometimes where people will frankly just ask about the deal and they don't even ask questions because they listen to a couple of podcast episodes or they've been tracking us on LinkedIn. Like we get very, very icy, white hot leads. Like
Mhm.
super, super hot leads that are ready to put money in and like don't even ask questions. Or, we've got a referral program right now where if you refer someone, we'll give you a fee on that, a fixed fee, and they're ready to go, and it's good enough for their friends, it's good enough for them. The way I look at it is if their friends have invested with you, they've taken that plunge, then their buddy is way more likely to invest with you than a random person, right? So focusing on the organic structure is great, and then obviously creating systems and funnels where people kind of inbound into your lap and know about you. I mean, it's funny. I've spoke to people. I speak to people once a month. I even say, or multiple times. Then I would say a month that have listened to a couple of podcasts and they think it's funny that they hear my voice on the phone call or that I'm calling them directly. Actually, crazy enough. So, or they've seen us on LinkedIn for the longest time. So. Interestingly enough, it's I'm always flattered and shocked by how educated people are on us and just the market generally speaking. So, I'm very flattered by that. Some people obviously, there's a little more hand holding, but they're interested in the space, and that's okay. But generally, people are pretty primed up.
Yeah, no, I agree with you. I think that's one of those things where generating the content pays off, because a lot of times there's a lot of investors out there. To your point, there's people on both ends of the spectrum. I'm kind of one of those people where it's just like, I like to just call, have a conversation. But there's a lot of people that will take a lot of time, with the podcasts and webinars and things like that and listen to stuff and come really prepared to conversations and know what they want to ask, if they even need to ask anything at all, So
And they're ready to be sold, which is
yeah, definitely. I mean, it's if you're not generating content, and spending time on a weekly basis to like kind of look overall. I like to look at like what questions I've gotten because chances are there's other people that have those questions as well, and then find ways to address them in webinars and on, marketing materials and blogs and things like that. Because it's like, yeah, it makes your job easier, your life easier, especially if you're raising a lot of capital, which it sounds like you guys are. Anything you can do to try to just next time around, somebody has that information accessible to them prior to a call, and it eliminates the need for, 2 hour conversation or 3 calls or something like that. Then that's great. I mean, it helps to kind of just systemize the process and all that kind of stuff. So let's change things up. Let's talk about the deals and things like that. So tell me about, like you've said so far, multifamily. You kind of gave us deal sizes and how much equity you need, all that kind of stuff. But talk to me, and you mentioned Texas is the core, moving into Arizona. So I'm curious. I have a bunch of questions, but let's start with just paint the picture of the kind of buy box, if there is one, an ideal property that you guys buy. Is it value add? What's just, I want to close my eyes and just paint the picture for me, what the property looks like and all.
Yeah, I would say this is going to be funny, agnostic to a certain extent, as long as we can make money on it. We don't want
Mhm.
anything too old to for the maintenance, or,
Mm.
if it's going to be a 70s property, it better have a good story as to why. We took down a 70s property deal last year in Dallas. There was all the makeups as for why. We bought 3 deals last year that were 2000s vintage properties, were from Cortland, which were obviously really, really high-end stuff. If you guys don't know who Cortland's one of the biggest owner-operators in the country. They usually develop, and if they have product, it's really nice. So we bought those deals and we threw a tax exemption on them. So I wouldn't say we're necessarily a one-size-fits-all glove or program there. We are looking for that mid-teen return any way we can slice it. That could be an affordable structure. That could be a value-add play. So it really just varies and depends based upon, where we're at, what we're thinking, and what the market's giving us. Recently value-add deals have been pretty tough to do because naturally when there's not a lot of rent growth, or rents maybe softening, it's hard to, make a value add return on tenants that have already, had their rents increased a lot. Maybe the property is already value added. You can't stretch them that much. So we've been really liking affordable structures where you buy nicer properties and we limit some of the upside or the rent for a subset of the units in exchange for a very, very hefty tax exemption on the opportunity, which obviously, you can improve your value of the property by decreasing expenses or increasing revenue. So right now, decreasing expenses we find to be easier to do, or a better playground to do, than increasing revenue, if you will. So recently been opting for those deals, but as absorption happens with all the supply coming online, as the economy does get better and the country does better coming up, like 2026 and beyond, I think rent growth will be possible. We'll probably go back to the normal value at play, coupled with our tax exemption structures where it makes sense.
God, I got a lot of questions there. I'm curious to what the acquisitions team looks like. Are you guys, is it in-house? Like, are you calling owners directly? Are you working
No,
primarily with brokers or?
these are institutional deals essentially. This is stuff that's really not owned by mom and pops, if you
Yeah.
will. It'd be very unique if it was. So through the market broker rate channels, I think a lot of times people who get in the space or are looking or interested think that they can send us an opportunity through their broker channels as if we haven't seen it before, or they'll send us
Mhm.
something that's just a junkie or not a good deal for many reasons. So we're going through the normal broker process, for the better or worse. It's interesting. This deal and the market's very fluid in the sense that there's just not many deals that aren't going to get marketed normally that would be interested in. It would be very unique in that sense.
Mhm. And okay, so and talk to me about the affordable side. So what's the kind of, just give us the overview of that? Is that a LIHTC, or like is it something like that, or is just a
No,
tax exemption or?
yeah, it's a public-private partnership with the local housing authorities, depending on the city that we're buying in, within Texas, and we basically, exchange or bring down rents or monitor rents a touch in exchange for a massive or a large tax exemption. That's typically speaking transferable to the next owner.
Okay.
So it's not just value on our end, but it's terminal value as well, and it's also creating affordable housing, which is great. Obviously, inflation's been really tough, and cost of living has skyrocketed, so we can only increase rents as according to the average wage increases there. So typically speaking, it's about 3% of year over year wage increases, which is fine, but it's not skyrocketing like 10-15% like you'd see elsewhere. But we think it's kind of a win-win-win. Tenants get a good spot, we get a nice return, and the city gets affordable housing. So, and that stuff is really hard to do just from a government funded situation, which I think with the USAID coming out, you see there's a lot of inefficiencies there. So creating a public-private partnership is typically speaking best for all parties involved.
Yeah, definitely. And that was my big question, was like, is there restrictions around the sale or something like that? And it sounds like there's not.
Yeah, it's just basically, somewhere between 5 to 8% of rents, or 10% of rents will kind of come down. But obviously, when you're taking property taxes down from, $1 million to call it 100 to $150,000, there's a lot of value in that.
Yeah, that's just massive. And I guess that helps the underwriting too to know, kind of upfront, here's what you have, and then it sets a somewhat of an expectation on what you can increase it year over year, that kind of thing. Take some of the guesswork out of that.
Yeah, I would say you kind of get your value out of return at closing in a sense because your NOI will jump about, 25 to 40% depending on the deal.
Yeah. Yeah. Is that something you're looking to do in Arizona when you move into that market, or is it?
Wouldn't it wouldn't likely make sense there because the property, I mean, there's different angles. We're not pursuing that there. This be more of a kind of a core plus, value add strategy as opposed to an affordable strategy of that nature. Light tech would be something on the table there, but property taxes and insurances are pretty non-existent in Arizona, juxtaposed to call it a Houston of the world there,
Yeah.
where you've got massive taxes there. Anyone in Florida knows, or I don't know about the Carolinas, but Florida and Texas are very similar states in from an insurance and property tax perspective, although insurance is probably worse in Florida. If you can eliminate or reduce your expenses there drastically, you're set up nicely.
Definitely. What are some of the metrics, or what's the data telling you that's bringing you into, did you say Phoenix specifically,
Yeah,
or
Phoenix,
okay.
yeah. Yeah.
What are some of the things you're seeing that's leading you there?
I mean, migration trends follow where people are going. There's still more people coming here than leaving. That's number one. Number two, it's very complementary, I think, just to Texas. It's also a red state, but not only is it a red state, it's just one of those things where, you look at Texas and you've got very high property taxes and insurance. And quite simply, the thesis is what's complementary. At some point, myself included, our investors are going to look around like, hey, I've got a lot of money in Houston here. Not that it's not great and you can't make a ton of money there, but I would like exposure elsewhere as well.
Yep.
So I think it's just a very logical fit within the portfolio. And also me being here in Phoenix as well makes everything a little easier too.
Definitely. Yeah. Now what's the operations look like now? Are you guys working with third party property management, or do you do that in house, or what's?
Yeah, we're fully integrated on construction and property management.
Gotcha. Interesting. So when you do you like if you're doing turnovers and units and things like that, or is that somebody in house is on the construction management kind of side and all? Wow,
Correct.
that's
Yeah.
awesome. And what's the typical hold period for a property that you guys buy?
Yeah, I would say anything we're acquiring right now, just moving forward, because obviously deals that were bought in 2021 and 2022 will likely be held for longer than that 5 year duration that we're projecting, or 3 year for that matter. But I would say anything we're acquiring now, we're kind of solving for a 5 year return and then or 5 year hold, and then a 2x equity multiple. So if you give us $1, we're trying to return two over the course of the period there.
Gotcha. And so talk to me about 2025. I mean, I think that's one of the things, and beyond too. So many people have been talking about all this distress coming down and multifamily. You guys subscribe to that? And if so, why? If not, why? I'm curious to your thoughts on that.
I think it's overplayed. I mean, obviously there'll be some deals that are not doing well. But will there be, rampant foreclosures like some GFC kind of setup? No, I don't think so. I do think there'll be good buying opportunities. I don't think it's generational, but I think there will be good opportunities where you can get deals at modest and good bases. But deals are only as good as the debt is, and cap rates aren't really moving that much in the space in the world that we're in with that 150 plus kind of middle market size. So, I do think deal flow will start to occur more. But fundamentals and it's tough because there's still a lot more equity that's ready to go. So equity kind of flooding into the market will make cap rates compress, obviously, or stay hold, despite where debt's at. And these institutions or other people don't get paid to sit and look at money; they get paid to transact and to hold deals. So I think the market will still be pretty competitive here coming up. I think the cap rate expansion is maybe will be at bay, maybe we'll go up a little bit per market, but I think that's still going to be tough. 25 will be a really good year in vintage, I think, because we're going to get good rent growth here coming up. But I don't think there's going to be some widespread, hyperbolic kind of, depression there, if you will. Just one person's opinion, though.
Sure, yeah. When you hear it on so many sides of the spectrum, but I tend to agree with you. I just don't see where that's coming from and why necessarily. I mean, so, but
There's obviously the walls of maturity and stuff, but I mean, I'm understanding that some banks will just wait until the
mhm.
principal comes back and then they'll sell the property then maybe they'll operate it. Maybe other loan mods will happen and stuff so the market doesn't get flooded. There's pref infusions, there's hope notes, there's preferred equity kind of funds that are kind of coming in there to save the day and stuff. So there'll be a lot of investors who maybe won't make any money or will have zombie deals, meaning they'll be in a property for 10 years and not make any money waiting
Yeah.
for the equity to come back. That's certainly a real thing there. But I don't think it's gonna be far and wide panic.
Hmm. And what's your take on like institutional investors and all? You mean, like you mentioned, you guys are in New York City, but you're working a lot with accredited investors, high net worth investors. Why not go the institutional path?
Um, there's a multitude of reasons. I mean, we'll consider it on the right opportunity there, if you will, but I do think that there is some, kind of strings attached with that money, like everything is, right? Control rights is a big thing. We're kind of seeing right now a lot of deals that are actually sold in 2024 and even this year, will be deals that were kind of forced sales because the equity wants out.
Yeah.
And that's just something that, is kind of tough. So we like the control there. And also, frankly, the fund to fund terms and stuff and, fund manager terms seem to be a little bit better. And, we do retain control because there's not one really majority player there, if you will.
Yeah, definitely. What's the benefit to the so with investors working through a fund to fund manager who's investing with you guys versus just investing with you directly? What's the benefit there?
I mean, they can set their terms and they're, set up accordingly if they want. There's not really an advantage or disadvantage, but we would hope people who, basically brought their investors a deal, they'd kind of honor that person there. We would never circumvent someone in that sense. Sometimes they can have lower minimums or sometimes they can get a little bit better of a spread compared to, what would be elsewhere because the fund manager is maybe dipping into his comp there. So I don't really have a good answer for you there on the cuff and on the fly there.
Yeah, I'm always curious. There's been so much of it over the last few years.
Well,
I'm curious where that market's going to go.
Yeah, it was a buzzword. I mean, it will stay there, right? Because third-party capital raising is super valuable, and frankly, the value there is, hey, I'm a fund manager. I look at deals all day long, and I've identified this is the best deal, and here's why. So that's the value there. But some people also don't really have relationships with their investors, so they're not really providing them much value at all, quite frankly. Some people are intimately familiar with their investors and know them better than anyone else, how they tick and how they work, and that's people that are valuable. And that's probably typically speaking the fund manager we work with, as opposed to someone who's just buying data lists and kind of spending out emails all day long and frankly scamming people.
So what's the future hold for Craig? What's your goals? What are you excited about? What do you want to do long term?
More of the same. Just want to play a lot of golf, do a lot of deals, and live the good life.
That's awesome. Well, what a great way to end the podcast right there. I appreciate you so much for being here. How can people get in touch with you, learn more about Lone Star and what you guys are up to?
Yeah, thank you, Peter, so much for having me on. This has been a really good conversation. If they want to get a hold of me, just go to my LinkedIn, very simple, Craig McGrouther, which I'm sure will be linked to the show notes. And then also, if they want to learn more about us, our deal flow, they can go to our YouTube channel or also our website, lscre.com. It's just basically the acronym for Lone Star Capital Real Estate, lscre.com.
Awesome. Craig, thank you so much for being here.
Thank you, my friend.